So I sold a stock last week that was down over 90% year to date. And the main reason I sold the stock is that I didn't see how the company could become profitable anytime soon. But the other reason was for tax loss harvesting. The stock I sold was Smile Direct Club, ticker symbol SDC. I bought this stock at $6.67 and then I sold it for 59 cents per share. Oof, that hurt. Anyway, but because I knew this was a spec stock, I didn't put a lot of money into it. So the total cost basis was $3,623 and the net loss was $3,303. This is why you have to be very careful with individual stock investing unless you know what you're doing. Because clearly, I didn't know what I was doing and I lost $3,300. But this video is about tax loss harvesting, and I'm gonna use Smile Direct Club to harvest some of the losses so that I can save some money on taxes for the year. If you're brand new to my channel, my name is Sai and welcome. My channel is all about how to achieve financial independence and retire early. I'm 36 years old and I've been on my Fat Fire journey for the last 7 years, and I went from $110,000 in consumer debt to managing over 7 figures in total assets. And ever since I paid off my stupid debt in 2016, I've been consistently saving over 65% of my gross income. And starting in 2023, I will save over 70% of our gross income so that we can retire early by age 45. And we have 2 taxable brokerage accounts that will fund our early retirement. Tax loss harvesting is one of the tools that we use to reduce our taxable income. This is not in any form of financial or tax advice. So before you decide to do what I did, please talk to someone, a professional, to make sure that tax loss harvesting makes sense in your financial situation. So tax loss harvesting is actually really simple to understand. However, here are some rules you need to consider before utilizing tax loss harvesting. 1, you can't harvest your losses generated in tax deferred accounts or your retirement accounts like 401k, IRA, or TSP. 2, you need to understand that in order for you to offset your losses with capital gains, you need to know that a long-term loss will be first applied to a long-term gain and a short-term loss will be applied to a short-term gain. 3, you need to understand that the wash sale rule applies, and which basically means that when I sold Smile Direct Club at a loss and I didn't wait 30 days to buy the same stock or a similar stock to SDC, then tax loss harvesting will no longer apply to my income. Some similar stocks that I can think of right now are stocks like Align Technology or X-Ray. So when I sold SDC on November 28th, I needed to wait until December 27 to buy the same stock, ALGN, X-Ray, or other similar stocks to harvest my losses against my taxable income. And you can also get my financial independence resources for absolutely free by visiting firesidechat.com/contact. You can also check out the Fireside Chat shop if you're curious about what I have on my display shelves, and I have all of my books and equipment at firesidechat.com/shopping. Now let's go over the basics of tax loss harvesting, and I've been reviewing my investment portfolio probably twice a week due to the volatility in the market in 2022. You don't necessarily have to do what I do. At the minimum, you should review your portfolio once a month or once a quarter, especially at the end of the calendar year in October and November. In 2019, the tech sector of my portfolio actually blew up with over 35% in growth in a year. And I decided to sell a portion of my tech stocks and invest in the semiconductor sector of my portfolio just to rebalance it. At the same time, I sold some airline stocks that severely underperformed for that year to offset my gains. So let's use this for example. In that year, I made $5,000 in profit from the tech sector and then lost $10,000 from the airline sector. If I didn't sell my airline stocks with $10,000 in losses, then I would have owed 22% in ordinary income tax because I held them for less than a year. But because I sold my airline stocks at a loss that I also held for less than a year, the $5,000 of the losses offset the capital gains in my tech sector. Makes sense so far, right? And I can now use the remaining $3,000 in losses to offset my ordinary income for the year. And then the remaining $2,000 in losses can be carried forward to offset income in future tax years. When you calculate how that $3,000 can reduce your ordinary income, first, you need to know what your marginal tax rate is. The marginal tax rate is the highest tax rate based on where your income lands in the tax bracket. This is different from your effective tax rate, which is the calculation of your blended tax rate from each bracket. For example, let's say your annual income is $200,000 and you're married and filing your taxes jointly. So the adjusted taxable income is $174,100 after the standard deduction of $25,900 for the year 2022. Your marginal tax rate is 22% because that's the highest tax bracket. Your income is taxed at that rate, right? Your effective tax rate will be the percentage of annual income that you pay in taxes. If you make $200,000 a year, your marginal tax rate may be at 22%, but your effective tax rate is 10% of $20,550 or $2,055. Plus 12% of $63,000 or $7,560, plus 22% of $90,550 or $19,921, equal to $29,536 in total federal tax for the year 2022. Now, you divide $29,536 by $174,100, then it gives you 16.96%. So your effective tax rate is 16.96%, while your marginal tax rate is at 22%. And if you need to watch it again, just rewind it over and over again. So knowing that your marginal tax rate is at 22%, then that $3,000 multiplied by 22% would be $660. And that's how you could save on your ordinary income tax. If your income goes up the following year and your marginal tax rate becomes 24%, then it's $720 in tax savings. Higher the tax bracket, the more tax savings you can have with tax loss harvesting. 32% will get you $960, 35% will get you $1,050, and 37% will get you $1,110, right? So not only I saved 22% of the $5,000 profit I made from selling my tech stocks at $1,100, but now I'm saving an additional $660 in taxes. The remaining $2,000 I lost can apply to future gains I make in 2023. And what's really awesome about my tax savings is if I reinvest that $1,000 each year in tax savings, that's $49,000 in 20 years with an 8% average annual return. Since December 31st is the last day I can harvest my losses for that tax year, I usually wait until the end of the year to carefully strategize tax loss harvesting. I also need to be very mindful of the wash sale rule, which means that I need to wait 30 days before or after the transaction of a capital loss to buy the same or similar stocks I sold at a loss to keep the capital loss deduction. And just to clarify, you don't need to have capital gains to offset losses. And I'm not sure if anyone actually had any capital gains in 2022 when I sold the Smile Direct Club stock and I didn't have any capital gains to offset. Instead, I just sold it to reduce my income tax liability. And I can't specifically give you any tax advice, but if you need help with your personal finances, like creating a budget or savings plan to achieve your financial independence, you can schedule a free one-on-one 20-minute financial coaching session by visiting firestarchat.com/coaching. And if you want to know more about how to make tax-free withdrawals on your investments and live on dividend income for early retirement, be sure to check out these two videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.